Welcome to the Atlas 2022 Year in Review. I'm Bruce Booth, one of the partners at Atlas Venture, and over the next 45 minutes or so, we're going to cover an overview of the industry, diving into the capital markets, the overall biopharma ecosystem, and an update on Atlas Venture. This year, in contrast to past years, we're actually going to start with a deep dive into the capital markets, because what an incredible and crazy roller coaster it has been. Within the capital markets, I'll cover the public side of things as well as the venture-backed ecosystem. Starting with the public markets and really taking a step back and looking at the last decade, the markets were on an incredible tear. We went from XBI, the S&P Biotech ETF index, of around 20, went up about eightfold over the course of the next 10 years. Punctuated by a few short downdrafts, this was an incredible time to build and finance young biotech companies at cheaper and cheaper costs of capital. That has changed. We've experienced the longest downdraft in over 20 years, 70 weeks from peak to trough, retracing valuations really back 6 or 7 years to 2016. Why don't we drill into the last 2 years in particular? Starting with the acute shock of COVID in March of 2020, setting the bottom of around 60 or so on the XBI, the next 11 months were an incredible tear. 164% gains up to its peak in February of 21. 21 was a very choppy year for the markets. An initial downdraft, choppiness throughout the year, and then really capitulating in early 2022, driving the markets down nearly 65% by the end. This was an incredible roller coaster, but importantly, this had nothing to do with biotech. This was very much general risk-off sentiment in the markets. If you look at the correlation with almost all of the other tech asset classes, whether it's fintech, innovation, internet, social media, or the Goldman Sachs Non-Profitable Tech Index, all of them traced each other. The correlation's very high. This was all about macro drivers, interest rate risks, and the belief that you can't fight the Fed, driving this prolonged risk-off sentiment in all of the growth sectors. The last time we saw this kind of correlation for this long of a downdraft was 20 years ago, the dot-com and genomics bubbles. If you look at the 52 weeks up until the peak, both in the current period and 20 years ago, they were up 150+%. Up to their peaks. On the genomics and dot-com bubbles, it took 2 to 3 years for the markets to finally find a sustainable bottom. We're about 70 weeks in and have certainly retraced much of that valuation. Now, while there are major structural differences between the capital markets 22 years ago and where we are today, there are some bubblicious similarities. In fact, these are textbook equity bubbles. Equity bubbles start, the markets take off, enthusiasm converts to the fear of missing out and total euphoria in the markets. Before they start to pull back, there's some denial and then fear and capitulation. And we've certainly seen this cycle over the last couple years. On the euphoria side, we were all saving the world from COVID. Whether it was Zoom and Peloton letting us survive and function in the pandemic environment, or creating vaccines, therapeutics, and medicines to help address the health consequences of COVID. Coupled with the fact that central banks around the world were helicoptering free money into the economy, finding its way into the markets, and inflating asset prices. Of course, all of this bursts. Interest rate hikes and the increasing discount rate on future growth, driving inflation pressure, the highest inflationary pressure we have seen in almost 40 years. Recession fears, coupled with geopolitical uncertainty and fatigue with the pandemic, really caused this whole equity bubble to burst. A lot of value has been destroyed during this period of time. To put that into context, if we look at the global R&D stage loss-making biotech, roughly 900 companies around the world tracked by Torreya Partners, their enterprise value dropped from close to $600 billion at peak in February to about $150 billion by June of 2022. That's an enormous amount of value destruction. To put that further into context, let's compare that to the valuation of Meta, Facebook's parent company, who has lost almost $600 billion from peak to trough, and in recent months, another $200 billion has come off their valuation. In short, Meta has lost more than the entire universe of biotech companies, nearly 1,000 companies, and several thousand new medicines. Another comparison, if we look at the 200 or so biotech IPOs between 2017 and 2020 that headed into this pullback in the markets, lost nearly $160 billion in value during that period of time. That's only 2/3 of what Netflix lost. It's about 1x of a Zoom loss and 1.3x of a Snapchat loss. Now, this isn't meant as some sort of cross-sector schadenfreude, but really to put into context that this was a significant risk-off collapse in the equity capital markets. Let's trace where biotech has gone during this period of time. The takeoff a handful of years ago, we were seeing signs of real enthusiasm in the marketplace in 2018. In my 2018 year in review, we teed up the question of, are these things signs of a frothy bubble even then? The 6 things we called out: venture fund flows, venture firms expanding into the space, tourist investors from other asset classes coming into the biotech venture world, capital per startup, IPO valuations and stage. All of these things have accelerated in 2020 and 2021 as euphoria and the real fear of missing out set in. If we look at how that affected the IPO markets, the number of IPOs and total proceeds all went up and to the right. We had record years in 2020 and 2021 with 80, 90 IPOs, raising $15, $16 billion in proceeds at valuations that were 2 to 3 times higher than where they were just a few years before. Of course, all of this have come off a cliff, down nearly 90% in terms of numbers as well as proceeds, with valuations tempering. If we look at the follow-on marketplace, it's a similar, though not as extreme, story. The number of follow-ons this year will pale in comparison to where we were the last 4 or 5 years, with significantly fewer proceeds as well. What about some of the underlying performance of these companies? If we look at the IPO classes of 2020 and 2021, looking at how they've performed relative to their IPOs into those June lows, nearly 90% of both of these classes were trading below their IPO prices. If we fast forward to the end of the third quarter this year, things got slightly better, but still 80-85% of these companies are agonizingly under their IPO price. Fortunately for the IPOs that have gotten out here in 2022, as of the end of September, we had 8 IPOs and 75% were above their issue price. A lot of criticism about these IPOs has been that there were too many early stage preclinical IPOs. Well, in fact, that's not the reason for the downdraft. In fact, preclinical companies have been the least poorly performing IPO within these 2 cohorts of IPOs. If you look at the companies that came public with phase 1 or phase 2 assets have actually performed the worst, both at the median and at the average. These companies were largely priced to perfection, and as they turned their early data cards with either mixed or maybe negative reviews, that led to a significant downdraft in their stock prices. That highlights this issue around turning data cards and seeing negative outcomes. By the winter of 2022, we were in a very unlucky period of time. 70% of the news was negative by Q1 of 2022. A normal, healthy biotech market needs 60+% positive news to create the right constructive environment for doing financings. We saw big negative news from a lot of generalist backed stocks like BridgeBio, Biogen, Allogene, and Allakos. It was a real challenge. As the markets pulled back, of course, around this cadence of negative news, we saw an increasing number of companies trading with negative enterprise values. It's now setting records at 200, 220 companies trading below their cash positions. Got better over the summer, but frankly, here in the beginning of the fourth quarter, it's back to where it was. A huge number of companies trading underwater changes the cost of capital dramatically. It's brutally dilutive right now for all of these companies to be able to raise the capital they need to get to their next milestones, and affects the cost of capital, of course, for everyone. And what do you do when your cost of capital gets much higher? Well, you have to belt tighten. And we have seen that across the sector. The number of restructurings that have been announced is at a faster cadence than I think any of us have seen over the last 2 decades. There's a couple different flavors of these. There's the "we're done" restructuring, which is really throwing the white flag, really shutting down your operating business and becoming a shell for a reverse merger, and we've seen a number of those. But another type is the live another day. Can you hunker down behind single lead assets, push those assets forward to their next milestone, and deprioritize all the other spending in your company? We've certainly seen a lot of those. Within those, the average RIF across these companies, the average reduction in headcount, has been close to 40%. So incredibly challenging times, but disciplined teams and boards have to respond to this increased overall cost of capital. Against this backdrop, heading into the summer, we witnessed some green shoots. The markets shot up over 50%, bottoming out at the low 60s. They were in the mid-90s just before Labor Day. What was all this about? Well, after the Fed increased interest rates in June, there was a belief that Fed tightening might stop, perhaps wrongly. Pandemic was fading. Biden announced the pandemic was behind us. Investors were starting to reemerge from their shell-shocked bunkers. Importantly, though, there was also a lot of melting up in the markets, where short interest had to get covered as the stock started to move forward, almost a head fake rather than an improvement in the markets from a fundamental basis. So you can see here, the higher your short interest, the greater your overall returns through the summer months. I'd say one of the silver linings in this, though, if you look to the far left, companies with very low short interest still gained 20 to 25% during that few short months of the summer, reflecting some of the very positive news flow that changed the constructive tone in the sector. And we certainly have seen it. We all read the news in August around great data, M&A events, new announcements around financings. This has largely led to a reversal in the percentage of positive news flow. Data tracked here by Morgan Stanley, we're now back into that 60+% range that usually underpins successful positive overall markets. And the market has been responding in a very good way to positive news. In fact, companies are being rewarded with, in some cases, over 100% single-day gains when they've announced really good news. Several of these companies are actually in the Atlas portfolio. We're privileged to be a part of Akero, Sparrow, Day One, Viridian, all announcing great data and seeing their stocks take off. In markets like this, when good data is being appreciated, data-driven financings become available to the marketplace. And that is indeed what we've seen. The markets reopened around follow-ons there in the third quarter, especially around companies with positive data news. So you can see it was a very slow beginning of the year, but accelerated there in August. Normally a sleepy summer month was certainly not the case, with almost $3 billion of financings getting done in August alone and roughly $7 billion in follow-ons just there in the third quarter. This certainly helps to create some of the constructive, positive feedback we've been getting in the markets to date, despite the choppiness in September and October. The follow-on market here needs to perform. It usually is a leading indicator for the opening of the biotech IPO market, which has largely been closed for most companies. So where does this all leave us on the public markets? It's really anyone's guess. If we continue to see positive news and some healthy dynamic in the overall marketplace, we could see the markets reopen. But the reality is there are a lot of macro pressures that could continue to plague the underlying market around interest rates, around geopolitical risks, and the like. So that's a wrap on the public equity markets. Why don't we shift over to the venture-backed private markets? Certainly a market that's also seen its challenges. Here's a 10-year view of venture funding. The gold bars represent dollars of venture funding. The white line is the deal counts. And you can see that in 2020 and 2021, really a tsunami of financing of dollars flowed into the biotech space, dwarfing where we were earlier in the decade. We saw two peaks in the first quarter of 21 and the first quarter of this year. We saw over $11 billion of funding go into venture-backed biotech companies. Of course, the third quarter of this year, likely around $4.7 billion, is way off of those peaks, about 60% down from the first quarter alone. But I think by all historic measures, it's important to step back and see how robust this actually is. The first half of this year was the strongest first half, except for 21. In the second quarter, more capital than in all of 2013, which was really the start of the bullish cycle and opening of the IPO markets. And the third quarter at $4.7 billion would be a top 5 quarter ever prior to 2020. And so there is still lots of capital available to build and grow successful biotech companies today. What about on the startup and venture creation side of things? We've seen a similar pullback into the third quarter of this year, both on numbers of financings and the proceeds raised in first financings. They're down by over 50%, really bringing us back to levels we were at in 2014 and 2016. I think it's important to remember, though, in 2014 and 16, there were some great companies created in that period of time. We helped start Intellia, Chimera, Generation Bio, and a number of others during that period of time. And so it's worth asking, is this new constrained environment for first financings reflection of healthy discipline, or will it create startup starvation? I'd like to believe it's the former. One of the areas where there is a pinch point in the venture ecosystem for sure has been the change in the crossover phenomenon. Over the last decade, the increasing role that blue chip public investors played in crossing over into private rounds and helping pull them public is well appreciated. Here we look at the top 24 public biotech investors and how they've participated in large biotech venture financings. That gold line reflects large deals without crossovers. You can see it's been relatively steady during that period of time, really driven by large venture capital firms. But at the peak of the markets in the first quarter of 21, nearly 60 financings involved the blue chip public investors, and that's down by 90% into the third quarter of this year. So they are sitting on the sidelines, watching these private financing, finding opportunities around depressed public equities that offer other opportunities for them to put capital to work. And there's also the denominator challenge. As their public positions have shrunk and their private valuations have not, the percentage exposure in the private markets has hit some of their limits. I think it will take a few quarters for this phenomenon to really work itself through, so I don't anticipate a significant change in their activity here on the private side. And so one of the things that gives me hope around and gives me confidence that we're going to continue to see lots of funding still happening in the biotech space is that VCs have raised a huge amount of capital in the last couple of years. According to SVB, over $40 billion in healthcare venture funds have been raised just in the last 18 months. You can see a number of these are specialists in the biotech space, like us at Atlas, having raised funds, Third Rock, MPM, and others. But there are also large diversified tech firms like General Catalyst or Bessemer with dedicated sleeves for the life sciences that have raised very large and significant new pools of capital. As all this funding has come together, it creates a huge amount of dry powder to put to work, and most of that powder will get put to work just over the next few years. So in a typical venture fund, 90% of the capital is deployed by years 4 and 5. And so a lot of the funds that have just been raised are likely to find their way into the coffers of biotech companies looking to grow. And so that's a wrap on the equity capital markets themselves, but these are really underpinned, of course, by the M&A markets. So the M&A markets this year have been relatively quiet and relatively light on overall value. While the number of deals has increased particularly recently, most of these deals are really quite small, especially compared to where we were on R&D stage M&A in 2019 and 2020, toppling over $50 billion, or on commercial stage M&A, where we saw lots of very large mega mergers between large pharmaceutical companies. Both of those haven't happened this year. I think on the R&D stage and commercial stage side of things, we're going to see roughly $50 billion of M&A activity this year across private and mostly public markets. What do some of those significant deals look like? Here's the league tables for a few of them. One of the things that I like about this list is it's a great mix across disease areas. There's cancer and autoimmune disease and neuroscience. There's also different modalities. We see small molecules, biologics, vaccines, and cell therapies. Importantly, we also see one name on here quite often. Pfizer's on here 4 times. It looks like Pfizer will have driven 50% of the aggregate deal activity on a dollar basis for the biotech space. What are some of the drivers behind many of these deals? Well, the first has been accessing late-stage products. This has certainly been a theme over the last year or so. The acquisitions of Global Blood or ChemoCentryx, assets that have just gotten approved or are near approval, a number of large deals have been within that sort of accessing late-stage product driver. The second has been getting access to cutting-edge technologies, drugs, or platforms. So Vividian's acquisition by Bayer, chemoproteomics pioneer, certainly a space we're excited about with the launch of Matchpoint more recently. But Gilead acquiring some very specific immune assets with their acquisition of MiroBio. So we're seeing activity in the early stage arena. We're also seeing bargain shopping, so value shopping of finding companies that are within your strategic framework but have had impaired valuations. Take Zymergen as an example. They went public in a SPAC at $3 billion. They were bought for $300 million, essentially at cash, enterprise value zero, by Ginkgo to bolt on their synthetic biology story. Epizyme tried to launch a drug, has struggled to get the kind of market traction it needed, was sold to Ipsen at 90% lower than its IPO price in the last decade. We've also seen more recently a number of gene therapy platforms get picked up for very small amounts of capital. In a lot of ways, given how long we've been in this market dislocation, I'm surprised we haven't seen more activity from pharma companies buying young and impaired, from a valuation perspective, impaired biotech stocks, especially given the amount of cash sitting on the sidelines. There is a huge amount on the balance sheets of the largest and profitable companies, Pfizer, J&J, and Novartis, all having north of $20 billion of cash available for deals. Within the profitable universe, there's over $300 billion in cash sitting there to deploy. If you calculate the theoretical leverage that these companies, based on their cash flow, could use, SVB estimates there's probably $1.5 trillion of potential buying power sitting on the sidelines today. So an enormous amount to put to work around driving and buying and securing innovation. Hopefully we see more of that rather than stock buybacks. As we look forward into the biotech ecosystem, I think we can think about the key ingredients that go into it, the first and foremost being great science. I think we are awash in great science today. There's tons of innovation, really a golden era for many areas of biomedical science. But we need three other ingredients: capital, talent, and space. On the capital side, with the number of companies going public, as well as the increasing burn rates of a lot of these companies as they grew in a world where capital was abundant, we've seen just a huge spike in the overall burn rates of our R&D stage loss-making public biotech companies. $50-60 billion were burnt in 2021 and likely here in 2022. Add on to this another 20 or so billion of private companies. So significant burn rate that has to be fed largely through equity capital. If we look at their cash positions relative to how many months of cash, there's at least 100 companies who have less than a year of cash ahead of them. These companies have to be accessing the markets now. And in 2023, there's another 200 or so companies likely to have to raise. So 300 plus companies are going to be active in the marketplace, and I am sure not all of these will successfully raise capital given the constraints we're seeing in terms of equity capital market flows. The second area that has a real constraint has been around talent. The talent war has continued unabated over the last few years, and despite the cool off in the markets, we're really not seeing it yet on the talent side of things. The chart on the left here is really striking. This is voluntary turnover rates in biotech across the country. It used to be roughly 1 out of 10 employees would be poached by someone else for alternative roles. That number has grown 80% just in the last 5 or 6 years to 1 out of every 6 people in biotech getting poached for other jobs. So that war for talent, being able to secure and access high-performing individuals is incredibly challenging. On the salary side, we're also seeing significant increases, up 33% or so just in the last few years, and this largely before any inflationary pressures set in. So again, huge constraint on our ecosystem and really a war for talent around accessing great individuals. One of the other important line items as you're building a company is having lab space, the ability to grow your footprint. This has been a very expensive part of the proposition in the last few years, with vacancy rates near zero and rents moving up at double-digit rates. But it looks like this may be changing. Let's take the greater Boston real estate market as an example. There's roughly 33 million square feet of lab space in the overall Boston marketplace, with vacancy rates historically near zero. But because of that demand, builders have put online and will be putting online 15 million more square feet of new supply, new buildings, new labs that will need to hit the market. And we've also seen, just since the spring of 2022, over 60 new subleases, bringing 1.5 to 2 million square feet of lab space available for young startups. And so I think we are approaching a period where there may be perhaps even an overcapacity of available space and perhaps a softening of some of the demand we've seen historically over the last few years. And so if you step back, while space may be softening and science is abundant, the two major constraints right now as we look forward over the next year or two are really around accessing capital and accessing talent. As we close out the capital markets section, I'll part with a quote from Warren Buffett that I think he attributes to his mentor, which is that in the short term, the capital markets are very much a voting booth or a popularity contest. But in the long term, they are a weighing scale. And in the biopharma business, what do we weigh? We weigh impact on patients. And that's a great segue to talk about the impact that the biopharma industry as a whole is having on patients across the board. So I'll touch on impact and then highlight some of the themes around collaboration and a few of the headwinds that our sector is facing. On the impact side, I'd be remiss if I didn't start highlighting the incredible response of the whole biopharma industry to the COVID pandemic. Whether it was bringing vaccines, new direct-acting antivirals, or repurposing anti-inflammatory drugs to address hospitalization in COVID, I think the industry should be very proud of how quickly it mobilized to be able to address some of these challenges. And given the evolving strains we're seeing from this virus, we're going to need to continue to deploy resources here and to help society grapple and cope with the ever-changing nature of the COVID pandemic. Part of the redeployment of these resources, though, may be responsible for a slowdown in overall FDA approvals. Over the last 6 or 7 years, we've been running at sort of 50 to 60 new approvals a year. This year looks like a bit of a rebuilding year. We're going to see closer to 30, 35 when all is said and done, much like we saw in 2016. But there are a number of great drugs in this mix. I'll highlight Sotyktu, the first allosteric TYK2 inhibitor, got a great, broad, and clean label back in September, a space we're, of course, very excited about at Nimbus. We've also seen in this mix of new drugs ex vivo gene therapies, whether they are autologous CD34 cells for sickle cell or BCMA CAR-Ts. We've seen an abundance of new modalities. We've also seen the repurposing of old small molecule agents in ALS. And we can argue about the data package or their pricing, but fundamentally it's great to see the industry bringing medicines to such an important and deserving community as ALS. Behind these new approvals, we've also seen lots of excitement from approved agents, and I'll highlight 3 of them here, all of which have announced great new data over the last year or so. And here too, the HER2-directed ADC, already approved in HER2-positive breast cancer, but showed striking benefits in HER2-low breast cancer, showing how you can take that therapy and the power of ADCs to penetrate deeper into the breast cancer population, offering new choices to those patients. Onpattro from Alnylam, going from polyneuropathy to the much broader market of cardiomyopathy, released its Apollo data and showing a very nice functional benefit on the 6-minute walk test here, demonstrating the broader utility of this important siRNA. And then lastly, Lilly's Mounjaro, approved in diabetes, showed very striking effects in obesity and body weight, here showing nearly 20% reductions in overall weight over the course of a year or two. Obesity has long been this sort of unaddressable marketplace, but it looks like that is beginning to change, and it's worth highlighting how large of an opportunity this is. 750 million people live around the world with obesity, and very few of them actually get therapy. Only about 250,000 get treated for up to a year. The gold standard has been bariatric surgery. It delivers huge amounts of benefits, but it looks like the incretins, Mounjaro, Wegovy, and others that are emerging, really deliver or are starting to deliver weight loss that approaches where bariatric surgery can be, reducing risks of cardiovascular disease, kidney disease, hypertension, hyperglycemia in ways that prior generations of obesity drugs never did. Behind these incretins, there's a number of new mechanisms, such as activin receptor antagonism, we're working on at Versanis, that potently target fat mass while preserving lean muscle mass. So an important wave of new medicines coming to bear. This has got analysts and pundits in the community very, very excited about the size and scale of where the obesity market can be, likely north of $50 billion by the end of this decade. Earlier today, SVB called this the electric vehicle market of biopharma, highlighting their enthusiasm for the high-growth nature of this space. One of the other themes within the recent approvals has been the role of genetics. This coming from a paper that examined the 2021 CEDAR approvals and looking at genetic evidence. As many of us have known, in oncology, this has always been important or has become increasingly important, with the vast majority having some genetic validation in cancer. But nearly 50% were actually directed to specific disease-causing mutations. In a somewhat striking number, of all of the other indications, a full third of them were directed against rare disease-causing Mendelian mutations. And so we have been following the breadcrumbs that nature has left us around target selection and target validation because of this, and we're now really seeing this in the crops of FDA approvals. All of this, of course, highlights that when you're following nature's lampposts, much higher probability of success when drugs are targeting proteins that have genetic evidence. One of the targets that we as an industry have gone after for a couple decades that has significant genetic validation has been beta amyloid. And this year, as we look to the late-stage pipeline, one worth calling out is lecanemab, probably one of the biggest catalysts of positive news flow that we've seen in recent months. It looks like the phase 3 data has replicated this phase 2 data that showed a 0.5 point reduction in the dementia deterioration in Alzheimer's patients. Now, statistically significant on primary and secondary endpoints. It remains to be seen, or time will tell, what the clinical significance of this is. But it's fair to say this is a real breakthrough for the space, finally showing definitive efficacy on a number of measures and gives many of us hope for renewed enthusiasm for investing into the Alzheimer's population. Behind this agent, there are many other great late-stage programs. I'll highlight 7 of them here. Sticking in the CNS space in frontotemporal dementia, the progranulin-directed asset from GSK and Alector, making good progress. That's a space that we're excited about at Arcuda. And then Karuna in schizophrenia published some really great and exciting data in schizophrenia earlier in the spring. We've also seen novel modalities. So Vertex and CRISPR with their ex vivo gene editing approach to sickle cell disease and beta thal really looks exciting, likely to get approved a year or so from now. 2 gene therapies in DMD have made it through some mid-clinic bumps, and both of them have embarked on large phase 3 studies. So looking forward to those outcomes. Merck, after the acquisition of Acceleron, just announced its sotatercept data in PAH, and indeed it looks like a great new option for those patients. And I'll close with 2 small molecules. Mirati's KRAS inhibitor continues to make good progress, showing that we can drug the undruggable. And at Novartis, the complement factor B inhibitor, going after that complement pathway that damages, in particular here, a set of rare kidney diseases. Really exciting new programs worth calling out, or exciting late-stage programs worth calling out. Indeed, it's also worth calling out 3 late-stage programs within the Atlas portfolio. So Day One announced some great data in the spring in low-grade glioma, really helping kids with brain cancer, one we're super proud of. Akero in NASH with their FGF21 approach announced great data in September, showing striking reductions around the liver, around liver fat and liver fibrosis. And then Nimbus moving its allosteric TYK2 into phase 3 next year. Really exciting time for the company as it branches beyond psoriasis and psoriatic arthritis there with its very selective allosteric TYK2 program. And so those are some of the wonderful late-stage assets, not only in Atlas, but the industry as a whole. If we step back to the whole industry pipeline, there are now nearly 7,000 drugs in clinical development around the world. Really a staggering number, supported by over $200 billion of R&D spend. There's lots to be excited about here, new modalities, lots of diseases, lots of clever approaches to bringing drugs to patients. But there are at least 2 concerns that I'd like to flag. The first of these concerns is around fragmentation and that Me Too projects can crowd out some of the more novel, newer, better ideas. Here's a look at the CD19 CAR T cell therapy space. There's over 110 of these different CAR Ts addressing CD19. The ones in the center are approved. It ripples out by stage. You can see there's just an enormous amount of activity, many incremental advances in that space. But the big question is how many of these as an industry should we be supporting, and can they really be supported by the indications they're going after? You could draw these bullseye charts for lots of other areas, whether it's gene therapies, gene editing, precision oncology targets. They all look the same. A lot of programs targeting a relatively small number of supposedly hot targets. Stepping back, this kind of resource allocation as a sector is one that I think many of us would agree is troubling. Another potential troubling area is the disconnect we have between our overall allocation into disease areas as a sector by pipeline and the unmet disease burden of those around the world. This is adapted from some McKinsey analysis of WHO data. If you look at the unmet needs on the y-axis, you'll see cardiovascular disease remains the most significant disease burden around the world, and yet is significantly underfunded and underrepresented in the pipelines of large pharmaceutical companies. Out on the other extreme, oncology is nearly 50% of the industry's overall pipeline, and while an important disease to go after, is certainly way overrepresented relative to its disease burden on society. Neither of these two issues are going to get solved by any individual company. Frankly, require leaders in the industry to start to think creatively and think about the bigger picture and collaborate in unique ways, which highlights the importance of collaboration. Collaboration has long been a cornerstone of our ecosystem. Looking at the recent FDA approvals is no different. Most of those drugs were originated or discovered in small companies, and they get launched and marketed by much larger companies. This trend has been in place for the last decade. Originators increasingly creeping up on being able to launch their own products, especially for orphan diseases, but it still reflects this important aspect to collaboration, in particular for larger drugs. If you look on the right-hand side, nearly 70% of big pharma pipelines and the revenue forecast from those pipelines come from drugs that they externally source. Another example of that is when you look at the top 10 drugs by revenue last year in 2021, all of these are truly mega blockbusters, just enormous overall products. 8 out of 10 of these were either externally sourced or globally partnered to be able to deliver these drugs to patients around the world. Of those 80%, 3/4 of them actually had partnerships while the main asset was in preclinical, highlighting the importance and value of early stage deal making. The early stage deal making we've seen this year has come in a lot of flavors. Accessing new modalities, whether it's going after molecular glues, cell therapies, oligotherapies. Accessing new modalities is a core part of this. What about licensing in very specific novel programs? These are ones where pharma has conviction, they find a biotech with that drug, and they do a deal. Or accessing new technologies. In particular, around AI and machine learning recently, we've seen a whole host of deals looking at applying that in the drug discovery setting. Or sharing unique capabilities, whether it's partnering your manufacturing platform, as Homology did with Oxford Biomedica on the AAV work that they were doing, or accessing other kinds of capabilities through these deals. Early stage deal making is super important. This year has been a record-breaking year for the number of preclinical deals likely to get done, over 400 this year, only beaten by 2020, where there was a huge number of COVID-related preclinical deals. But all in all, a super important part of our ecosystem is the collaboration between large and small companies in the space. I'll tell you, one of the things in recent months, though, that we've started to hear is the role of the IRA, the Inflation Reduction Act, and the drug pricing reform around how these deals are getting constructed. So that's a great segue into the 3 headwinds I'd like to talk about: drug pricing, regulatory obstacles, and the M&A tension. With drug pricing, the IRA is now the law. It's the largest biggest reform of drug pricing we've seen in over 20 years. Medicare effectively sets the price for drugs that get to be significant or after a certain period of time. Analysts suggest that this probably drops long-term value ascribed to pipelines by 30, 40, maybe even 50%. There's a few perversions in the law that I think are worth mentioning because these are significant and have very negative consequences to how we think about biotech R&D. First off, small molecule drugs versus biologics. 9 years versus 13 years of protection. Why are we incentivizing inconvenient, complex therapies instead of simple oral pills? This is not good for patients. And secondly, around the real implications for how we stage drug development and R&D strategy as a whole. Instead of coming to market with a single sentinel indication where you can get approved and then expand to lots of other potentially larger indications, or come to market with a last line of therapy cancer medicine and move your way up into second and first line. Instead of doing that, companies are going to hold those drugs in R&D, not push them to approval, essentially delaying drugs for patients. In addition to delaying drugs, it's clear based on the CBO's analysis that fewer drugs will reach patients as fewer things will be funded to be advanced into the clinic and eventually the market. So all in all, some very serious consequences to our sector that are just being digested and internalized. In the last few weeks alone, we've heard of 3 or 4 companies, Alnylam, Alkermes, Lilly, actually shutting down or deciding against advancing certain assets because of the IRA bill. There is potentially a silver lining in this for small and mid-cap biotech companies. As we have price pressure through the IRA, through the $110 billion of revenues that are exposed to patent expiry over the next handful of years, compounding that overall price pressure, companies will have to make it up in volume. Very hard to make it up in volume with your own products, which highlights the need for more new products, which likely means more M&A. All of that would obviously be good for those small and mid-cap biotechs that have interesting assets. The second headwind I wanted to talk about was regulatory. Look, the FDA has been challenging. I actually expected this complete response letter, so rejections or holds, I expected these to be up and to the right, given the tone and tenor of engagement that we've seen from the FDA. But in fact, it highlights that the FDA has been a challenge over the last few years with significant negative activity here directed towards clinical stage programs and new applications. Interestingly, though, while the FDA has taken a tough stance on many issues, they've been sort of oddly lenient on others, like data light neuroscience approvals. So in my conversations with pharma leaders, as well as within our own portfolio, it's becoming clear that other jurisdictions, whether in Europe, the UK, Australia, elsewhere, are becoming more attractive as places to do initial clinical work and translational medicine. Doesn't bode well for U.S. innovation. The third headwind is around M&A and the FTC. This became an issue a couple years ago as the FTC was voicing concerns around M&A in the biopharma space. To date, I think most of this has been all bark and no bite. And while the barking has definitely delayed some deals and caused a change in posture around some deals, to date I am not sure that the FTC has actually rejected any M&A activity outright in our space. That may indeed happen, and I may not be privy to it, but I think stepping back, most of this has been around a lot of noise around M&A and competition, but really hasn't had a material effect on our deal-making activity in the space. And so if you step back from these 3 headwinds and think about the overall impact we've had as a sector, I think it's a great reminder to think about life expectancy. Over the last 50 years, life expectancy has gone up tremendously across the globe. It's estimated that 35% of this impact is due to new pharmaceutical agents. That's something we can be super proud of. And I think this will continue to accelerate as we bring biomedical scientific breakthroughs to patients and society. This is something that all of us as a sector should be very, very proud of. And indeed, I'm very proud of the work that we're doing here at Atlas Venture. So with that, a great segue to a quick update on Atlas Venture. Overall, our strategy, 6 core tenets: seed-led venture creation. We find science around the world and build therapeutics companies, really early stage biotech focused, with the mantra of doing well by doing good. The last year or so, by the numbers, we started 6 companies. Our portfolio has now moved north of 50 active portfolio companies. Across those 50, $2.4 billion were raised just over the last 12 months, despite the challenging capital markets. We've had 4 IPO and M&A events, and the aggregate portfolio value of our realized and unrealized portions of our active companies is worth well over $4 billion, significant multiple over its cost base. What does the Atlas portfolio look like? Well, if you take a disease or modality approach, you can see that we are very much agnostic to either of those. It's a science-first overall portfolio. On the therapeutic area side, that distribution looks very much like the industry, slight overweightings in areas like rare disease, perhaps immunology. On the modality side of things, we've invested in conventional, traditional modalities, small molecules and antibodies, but also a number of novel cell and gene therapies, gene editing, oligo approaches. And so if you roll up the whole portfolio, Atlas looks a bit like a mid-sized pharma pipeline. The purple lines there are from 2016 by phase. You can see a big uptick through 2022. We now have over 50 programs active in clinical development today, phase 1, 2, and 3. And just in the last 12 months, 15 companies announced new study initiations across the board. So lots of things to be excited about here in the Atlas portfolio, but it's also good to reflect on some of the impact we've had more broadly. Here's 20 medicines that were made by legacy Atlas portfolio companies at some point, whether it's Emgality, now at Lilly, from Arteis, Alnylam, Morphosis, Actelion, lots of exciting agents here and having impact for patients. But we don't do this all by ourselves. We do this through collaboration, and this year was certainly no exception. Here's 5 of the selected deals that we did in the last 12 months or so. BBio in the cell therapy space, Q32 in the autoimmune area, Remix, RNA-directed agents, Scorpion in the precision cancer space, and Nimbus partnering a metabolic disease target with Eli Lilly. All of these are important because not only do they help access capital, but they access partners who can help bring these medicines to patients down the road. Besides partnering as a source of capital, accessing the public capital markets has been important. Vigil went public in January and did a second follow-on investment in August. Third Harmonic came out in September with the first IPO in 4.5 months, raising a significant amount of capital. And Disc Medicine, in a reverse merger, will have over $170 million of cash on its balance sheet to be able to deploy. All 3 of these accessing the public markets this year. I think it's worth noting, in the spirit of collaboration, all of these were done in partnership with our colleagues in the pharmaceutical industry. Vigil was partnered with Amgen, Third Harmonic with Novartis, and Disc with both Roche and AbbVie. So we're proud and excited to work with those firms and with these companies as they turn the next card on their clinical data. But not everything always works in our portfolio. We are, after all, seed investors, so early stage science can fail. Here are 3 examples of disciplined venture creation we'd like to highlight. In sleep apnea, RNA degradation, and in epilepsy, these were all seed investments where we had a thesis that we wanted to test, and during that seed phase, we designed a set of killer experiments, executed them with virtual network of CROs and the like, but really failed to reproduce the academic findings or failed to get enough conviction that those observations were supporting the build-out of a full new company. The not so bad news about this is it was relatively inexpensive. We invested $5 million across all 3 of these, and the team members have all been recycled onto other Atlas projects. This is what seed-led venture creation is all about. It's bending that risk curve so you can put more capital into deals that are working. In a typical venture fund, roughly half of the deals that you invest in are below 1x. In our portfolio, that's about 40%. That's called the deal impairment ratio. 40% of the deals don't make money. But 75% of our capital actually goes into deals that make a positive return. And so when you're able to bend the risk curve on the bottom end and get more capital into winning deals and access the far right-hand side of the tail with your winners, you're able to generate outsized returns. And so here's a chart of our performance from our maturing funds something that we're all very proud of. But if you look at it from a public market equivalent return, so essentially taking the capital that normally we would do capital calls for, deploying that into the NBI Biotech Index or the S&P 500, you can see the relative outperformance here as a percentage point difference in returns across those two funds, 60 to 70 percentage points of outperformance, something we're enormously proud of over the last handful of years. But of course, it's not just single individuals that do this, it's the full team. So I'll highlight the Atlas investment team. There's 6 investing partners and a great overall investment team. And a number of these have all joined just in the last couple of years. This great investment team is supported by and couldn't be nearly as successful as we are without an incredible operations team led by Omer Chauhan, our CFO, but just a fantastic group of people, again, many of which who've joined us in the last couple of years. And so a real privilege to work with such a talented organization here at Atlas. And I'll close out just by reflecting on, we closed Fund 13, a $450 million fund in February. We closed on our Opportunity Fund, which is really growth capital for our portfolio, late last fall, giving us a significant amount of dry powder capacity to be able to start, build, and grow the next wave of great biotech companies. And so with that, I'll close out the Atlas Year in Review. Thank you for your time and attention.